it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, May 29th, and I hope everyone has enjoyed a Memorial Day week or Bank Holiday week in the case of the UK, and looking forward to discussing the continuing flood of news that we're seeing this week. And to take us through some slides, I'll kick it off now. I've called this podcast A Rose by Any Other Name, as it's clear that there is some pushback to Donald Trump's tariff agenda. The news is changing on the fly, as when I drafted these slides, it seemed like a court had suggested that the tariffs were not effective and could not be put into effect. And now that very same court ruling has been placed on hold pending an appeal by the White House. So it's, of course, the reason it was called A Rose by Any Other Name is there has been a strong suggestion that even if the Donald Trump's tariff agenda is derailed by the courts, that a workaround or some other way will be put in place for him ultimately to achieve the same results and effect the agenda. The suggestion, therefore, being that he's not, certainly that checks and balances could get in the way of this. But now we may have another meaning for the rose of another name, but let's move on to our usual agenda. So inflation, interest rates, equity markets, geopolitics, and other is the usual set of topics for the week. And we are going to talk about a walking taco. Initially, we've seen the new acronym du jour, or at least of the week, being TACO, coined by a Financial Times journalist. Quite a provocative acronym. Trump always chickens out. A way to play the tariffs, in that it was suggested that tariffs were on again, off again. We had spoken last week about the other acronym that was getting some traction, the ABUSA, anything about the USA. It seems like another week, another acronym. But I've called this a walking taco, as it does certainly seem to be a moving target in terms of whether or not this is in fact the way that tariffs will play out. And as a provocative acronym, using it could even have the unintended effect of actually not having the president chicken out. So I think we have to be extremely careful with how this particular acronym is used. It's quite a bit more loaded than the old-fashioned Tina and Tara that we were used to. This week, we've seen bond vigilantes take a breather. They don't seem quite as intent on beating up on any administration that is not sticking to a strong fiscal discipline. And they seem to have backed off somewhat this week. So we are seeing them take a breather. We're seeing some surprises in terms of confidence, and I'm going to show some slides that compare consumer confidence in the US to CEO confidence, and perhaps there's a story within that that is worth parsing. And as always, we look at the meaning for portfolios and where we go from here. Starting off with inflation, even though we haven't had much news on inflation this week in terms of numbers, it's clear that inflation will continue as a concept to wrestle with the tariff problem. The question that has been on everyone's lips is how much price hikes will be passed through to consumers due to tariffs. And we're already seeing a bit of a mixed bag in that effect. We've seen some threats of that come from Nike, for example. That this was a slide from last week. They suggested that they would increase prices by up to 7%. We've also seen Apple suggest that they would pass them through, as well as Walmart. And that then did provoke a reaction from the Trump administration suggesting that they should eat the tariffs and not pass them through. However, if we look at some other companies who have already passed through tariffs, the likes of Best Buy, for example, this seller of electronics in the US has already been building in a preemptive way price increases due to tariffs into its goods, and it does not seem to have affected demand that much in that case. This, of course, could be the ever resilient US consumer not skimping on electronics purchases, but it is interesting to see that already perhaps some of this, the tariff action, is already in the price, so perhaps it's not yet to come. We've seen overall still markets and the Federal Reserve in consensus in thinking that tariff policy will push inflation up. But we can also see that we're seeing sales, for example, of software, such as Salesforce.com, that has seen its full year sales outlook being increased. So it is clearly seeing an ongoing demand for its products. And I would suggest that there is a certain price insensitivity when it comes to this kind of a core business software. So right now we are still trying to figure out the impact that inflation is likely that tariffs are likely to have on inflation. And we know that whereby in the US they were somewhat stalling the inflation numbers, we do know that in Europe they've been falling. And we spoke last week about the UK having an unpleasant surprise spike back above 3%. So more to come on the inflation story. Suffice to say, we're not in a position yet where we know that interest rates can be cut by the Federal Reserve, but certainly a mixed picture on inflation emerging. The second story we have development on, and these are all developments which is getting back to my thesis that instead of one overwhelming narrative that we're seeing in the current market setting, it's almost like having a series of YouTube shorts. We have short narratives that last perhaps sometimes as little as a day, and the tariff court action is another example of that. But even the aversion to the big is beautiful bill, the big beautiful bill that was in place, the suggestion that that was going to be very detrimental to the budget deficit now seems to have, that narrative has ended and has now even come into reverse. So just to discuss this impact of Trump's proposed tax bill, there's a suggestion that this would add $3 trillion to the US national debt over the next decade, increasing federal government debt held by the public from about 98% of GDP to a record 125% of GDP. So this was the narrative around the Trump tax bill that was circulating last week. And this was the narrative that it was said to kickstart the bond vigilantes into selling off government debt and leading to yields spiking. And we saw spiking in the 10-year as well as the 30-year. Now that narrative seems to be a lot less doomsayer filled and a lot less precarious for the federal budget deficit. Now it's suggesting that it would add less to the debt stock than what expert forecasters had expected. And there was a suggestion that, especially after tariffs, that the impact on the deficit would be far more modest, well away, almost closer to the low case of the Trump campaign. If you remember back when we discussed the Trump trade, many months before the election, we discussed that there was likely a low, a central, and a high case in terms of the proposed budget, the impact that would have on the federal deficit. And now we can see that the current interpretation of the big beautiful bill is that it will be barely above the low case of the Trump manifesto, so suggesting far less damaging to the federal budget deficit than previously thought. Of course, this bill has not even passed both houses at this point, and there could be some resistance to it, some modification, but certainly if tariff revenue is forthcoming, it could be a lot less damaging. So that could be positive for bonds, could encourage the bond vigilantes to take a breather, which they seem to have done this week, and to even be more, I suppose, of a boost for the US dollar, which was, as we've seen before, has continued to be weak in the light of this lack of confidence in fiat currency. The macro environment, though, just setting up for the current equity market environment, even though the equity markets have been quite strong, the macro environment is not looking necessarily better. We've seen a confirmation that the US economy did shrink in the first quarter. It shrank at about 2% according to the current revised estimates. We know that this was a slightly distorted number in the first quarter due to the effect of exaggerated imports and extra high imports, as there was some form of stockpiling in advance of tariffs coming into effect. We can see that when it comes to the US business equipment, orders did decline in April, with capital goods shipments falling for the first time since October. Again, this could reflect front loading of business equipment orders in the first quarter. And certainly we saw evidence of that with Apple packing jumbo jets full of apples. So this could again be an aberration, but still not a positive number out of business orders there. Again, we've also showed quite a dramatic shift in consumer confidence over the course of the last few months. We've seen it record, it was said to be a 3-year low at one point. We said that the consumers were perhaps showing increased concern about inflation, as well as a lack of confidence in just the outlook for the economy. We can see, however, that there has been a jump in US consumer confidence just in the last month, that has jumped the most in 4 years, that expectations around the economy are continuing to be stronger. And it's had the biggest rise since 2009, according to the Consumer Conference Board and Bloomberg. So why, I would ask, would there be a reason to have this jump in consumer confidence? Is it relating to the fact that an acronym has been created about the on-again, off-again nature of tariffs? If we've got to the acronym stage, does that suggest that some behavior has become so expected, so normalized, that we can suggest that perhaps the center will hold, the financial system will hold, the market economy will hold, and that even attempts to derail it, perhaps not intentionally through tariffs, but by collateral damage, they will not ultimately be sustained. Is that why consumer confidence has ticked up? I can't really see any other particular reason for consumer confidence ticking up, unless it is taking some kind of a read out of equity markets rallying again. And we'll show later that the Mag 7 are back to their raging run that they've shown before. But otherwise, we have the kind of nagging concerns about AI. We have interest rates remaining high. That's been poor for the housing market. A lot of other negative data points that this jump in consumer confidence does seem to be a little bit of an outlier. And equally, if we compare consumers to CEOs, we might ask ourselves who would be the most knowledgeable counterparty in this case. CEOs are not showing the same level of confidence. 83% of CEOs, according to the Wall Street Journal, have said that they expect a recession in the next 12 to 18 months, according to the Conference Board CEO Confidence Index. So all of these charts on this slide are from the Confidence Board. And if 83% of CEOs still expect a recession, this could again be trying to get some bad news out of the way first, suggesting that they can then manage expectations around their own earnings. But this isn't just public company CEOs, this is all CEOs. So what are they seeing in terms of consumer demand, in terms of slipping orders, or just in terms of the general pervasive uncertainty? But I think this counterpoint between consumers and CEOs is quite an interesting comparison at the moment. Looking at other news, jobless claims rose, not by a tremendous amount, but certainly higher than the week before. 240,000 people in the US filing for unemployment benefits. And then when it comes to home sales, we've spoken before about the spring season being a bit of a bust, traditionally a boom season for home sales, that they've fallen in terms of the actual volume of sales for the second straight month, and equally that the price index has been sinking. It was sinking in April, the average price paid, which was by more than offset the price rise in March. So not a challenging, quite a challenging time for if you're looking to buy or sell a house, and again directly related to the stubborn level of rates remaining high as they are. However, just as we've spoken about this TACO acronym, markets certainly have been feeling positive vibes. The most recent example of tariffs being put on hold was around Europe. That was an unpleasant Friday surprise last week when we saw the slapping of 50% of tariffs on Europe, a suggestion that there was a dissatisfaction with the pace of the tariff negotiations and that Europe would be the next to get these punitive level of tariffs. And that does seem to have been rolled back already. And that's where we've seen markets have been quite positive. There's also been tremendously positive news out of Nvidia, as well as the rest of the Mag 7, particularly Microsoft. And that has perhaps also been contributing to quite a positive vibe around markets in this past week. Another example of just workarounds and roses by other names. This headline came before the ruling was put on hold, given the likelihood of an appeal by the White House. But Pete Navarro had said that nothing had changed after the tariff ruling, that essentially there were many other avenues whereby the Trump administration could achieve its objective around tariffs and around leveling the playing field and certainly securing some form of reciprocity. And they did not even have to go down this route, it seems, as they've already been able to place a hold on that legal action. But certainly, I think when there is an agenda like this, there will be many workarounds and ways of getting there. When it comes to the Magnificent Seven and equity markets, their outperformance relative to the other 493 in the S&P 500 has continued. The chart on the left shows just how that outperformance did dip around about the time of Liberation Day and tariffs, and certainly the first few months of the Trump administration. But now they're off to the races again. And if we break down where the actual performance has been so far this year, it's interesting that despite the fact that we are still outperforming and in an outperformance zone versus the other 493, not all of the Mag 7 stocks have behaved at all similarly into 2025 so far. Meta up 10%, Microsoft off 9%, Nvidia, despite its incredibly fast sales growth and strong numbers, despite the banning of certain certain exports to China from certain of its chips that had an $8 billion hit to earnings, Nvidia is flat for the year, Amazon down 7, Alphabet or Google down 9, Tesla down 12, and Apple down 20. So quite a bit of dispersion within the Mag 7, but overall still outperforming the other 493. And that is, again, a bit like deja vu in terms of the way the markets had been performing relative to now. A little bit of muscle memory. This could be influencing the strong investor participation going back into markets as they're now just used to seeing this level of performance. And if we look then today, Nvidia's numbers have been in focus. The sales growth, even in the aftermath of DeepSeek and other suggested aggressive movers on its moat, potentially losing its moat as a first mover. Its first mover advantage is undeniable, and its growth of sales has been quite decisive. A story that doesn't get much attention because it's somewhat behind the scenes and not part of the flooding of the zone is the steady, I'd say stealth, breakout by Europe into a different type of spending and just a different type of modus operandi when it comes to investing in its beleaguered industries. We saw the beginnings of this in the aftermath of the famous Munich speech by Vice President J.D. Vance. We saw a galvanizing of attention around some of the need for industrial spend. We saw a release of the fiscal brake in Germany and a likelihood for $1 trillion in spending to be forthcoming, particularly on defense stocks. And we've seen a rallying of stocks there in as a result of that. We can see that this news is continuing to percolate throughout Europe. We can see that now we're seeing Germany going from hawk to offender, that they're on a spending offensive. They are looking equally to support its own heavy industry. So this might be the kind of controversial governmental intervention and basically not creating a level playing field as they're seeking to ultimately to support its own, have subsidies for German energy intensive companies and really ensure that there is no falling behind of this industrial base in Germany. So this could be short term a good fix for the German industrial production. Of course, in the long term, state subsidies have generally not been a good fix. They have discouraged competitive advantage unless there is a desire, and we've seen some hint of this, to actually get the Europe back working again in a productive fashion. Any state subsidies would almost have to be aligned with that equal focus on worker productivity in order for that not to be a crutch. But just behind the scenes, I'd say Europe is stealthily, when it's not in the headlines, is breaking out. And of course, the win on tariffs and getting the stay on tariffs has been another way for them to protect their position right now. Back to other news, we still have the story around Bitcoin and gold, and these are actually slides from last week. It did top 110,000 last week, but I'd say what we're seeing is just increasing evidence of these two assets essentially being seen as an alternative, a diversifier to fiat currency. Not the same in many ways, one being more of a store of value, one being less of a clear-cut store of value, but certainly alternative assets and alternatives to gold, to holding fiat currency, and a good currency diversifier. We've heard some managers speak of them as. So that could be another example of assets that we're seeing shore up this week. And finally, I think it's worth giving the last word to understatement of the week. In an earnings call with Dick's Sporting Goods, the CEO there cited dynamic macroeconomic environment as the prevailing backdrop against which their sales were being experienced. We're also hearing Cole's CEO talking about the stretch shopper. So if we think of this environment as being one of dynamic factors, and certainly it is, and I mentioned before, each narrative seems to be getting shorter and shorter in terms of its lifespan. That is, of course, a very difficult market in which to operate. I've spoken before about the problem around uncertainty. And even though many of this, the whole concept of TACO, the whole concept of having a policy in place and then reversing that policy, that is chipping away at the certainty and the norms that have been the environment against which most businesses have operated. And even though we're still seeing some strong numbers, we're seeing stronger consumer confidence, I think the CEO confidence number is a sign just that this uncertainty is chipping away at the ability to plan and more of a long term. So whereby some of these short-term fixes and short-term news may be positive, and certainly investment portfolios may barely feel the impact of some of the macroeconomic dynamism that we've seen. I'd suggest that this uncertainty is likely to gnaw away and ultimately weaken the foundations of this market. So that's something we have to look at going forward. In terms of what this means for portfolios, looking at some of the M&A that we've seen over the course of the past week, and we've had some pretty sizable deals be announced. I think it's important to bear in mind that there is a great store of value and innovation in the private segment of the market. This is an area that increasingly private wealth clients are now able to get exposure to in terms of private equity and private credit. I'd suggest that the recent M&A we're seeing, getting exposure to that phenomenon, those sizable buyouts, where can you get exposure to that phenomenon? It is through investing in venture capital, private equity, that continues to have a strong bid. I suggest the resilience of the consumer and the resilience of the economy is all a good backdrop for all of those factors, that the equity as well as the credit side. We have very resilient institutions, and that again also bodes well for how these deals are structured. So I'd say if we had any message for clients that we were meeting this week, it would be that to take comfort that markets have round tripped essentially and remain quite strong, to take comfort from the consumer confidence, take comfort from the center holding when it comes to the some of the shocks that have been thrown at the system recently. The system has held, the system has held, the system has prevailed, and that should all be something we take comfort from, but that we need to continuously be looking for opportunities that are emerging as the environment continues to change with this dynamism. And I'd suggest that some of the private assets are just where we can find that. So that is our Markets Happy Hour podcast for this week as we end another month of May. It is great to see you all, and thank you for your following. And we'll look forward to kicking off the last month of the first half next week.